This is Trade Flow News, bringing you relevant news and insights from around the world. Trade Flow News, enabling trade for SMEs and economies worldwide.
Welcome back to Trade Flow TV. You know the drill. Markets move fast, and if you're not ahead, you're under. It is Monday, June 15th, 2026, and today we are zooming out from the central bank noise to focus entirely on the physical world. The global commodities complex is actively fracturing into distinct winners and losers, driven by hard logistical realities, AI infrastructure demand, and a shifting geopolitical map. Let's get you caught up for the global open. First up, the 60-second commodities flash. Brent's Hormuz overhang continues. The energy squeeze remains the defining macro story of the year. Fitch Ratings has officially projected that Brent crude will stay heavily elevated between $100 to $110 per barrel through July. While paper traders hope for a swift reopening of the Strait of Hormuz, the physical blockade continues to trap roughly 1/5 of global oil consumption. Copper faces a structural deficit. Industrial metals are shrugging off geopolitical fears. Copper is holding strong near $13,600 per ton on the LME. Despite looming tariff roulette headlines, the physical fundamentals remain incredibly tight due to a massive collision between booming demand for AI data centers and severe global mine supply disruptions. Precious metals test support. The shiny stuff is taking a structural breather. Gold has officially slipped below its 200-day moving average. Gold is pressured by a resilient US dollar and hawkish Federal Reserve risks following sticky inflation data. However, silver is showing massive resilience. Silver is surging on the back of heavy industrial and manufacturing demand. Finally, we have the WASDE agricultural shock. The USDA's highly anticipated June WASDE report just hit the tape with a major warning for food inflation. U.S. wheat production forecasts were slashed. Meanwhile, soybean futures took a 6.1% hit over the last month, dropping to 1,132, caught in a vicious tug-of-war between biofuel demand and shifting global weather patterns. Let us take a deep dive into the aggressive divergence within the global commodities market, where industrial metals surge on tech demand, agriculture faces supply shocks, and energy remains trapped by geopolitics. The data hitting global terminals this morning proves that treating commodities as a single uniform asset class is a surefire way to misallocate capital. Look at the energy timeline trap. If you are trading oil right now, you are trading a timeline, not fundamental demand. Fitch's base case scenario assumes the Strait of Hormuz reopens by the end of July. If that happens, they project the market will swing back into a massive oversupply by September, dragging crude back down to the $70 to $80 range. But until that physical choke point clears, the current price spike is a pure logistical supply shock. Dark fleet tankers are attempting to bypass the blockade. It is not enough to offset the 20 million barrels of oil equivalent per day that are structurally disrupted. Do not short oil until the ships are physically moving freely. Next is the metals super squeeze. We are witnessing a regime change in industrial metals. Unlike energy markets, copper is facing a genuine, long-term physical deficit. The rapid build-out of global AI server racks, data centers, and grid infrastructure requires unprecedented amounts of wiring and heavy cooling equipment. When you pair this explosive tech demand with deep supply-side constraints at major global mines, copper becomes the ultimate hard asset play of 2026. Do not ignore the agricultural margin crush. The USDA's June WASDE report confirmed that U.S. all-wheat production is dropping, with the all-wheat yield falling to 47.0 bushels per acre. When you combine this domestic wheat shock with the structurally high costs of petroleum-based fertilizers and marine freight, a secondary wave of global food inflation is cementing itself. Farmers are being forced to pass elevated input costs down the supply chain, meaning central banks will have an incredibly hard time justifying any dovish rate cuts this summer. Here is the trade flow take. Today requires extreme sector selectivity. The structural bull market in copper and base metals is heavily supported by the undeniable growth of global AI infrastructure. Meanwhile, the energy market remains a binary geopolitical bet. Rotate out of generalized commodity index funds and take targeted positions in industrial metal miners. Stay liquid, stay sharp. See you on the next one.
That is all for today's news on commodity markets. Stay tuned to Trade Flow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at Trade Flow News, which allows you to watch our program on your mobile device or desktop to receive information from there.